All right, welcome traders to a brand new week. Now, there's a lot on the market's plate this week, everything from very important US economic data. We also have some central bank decisions in the mix. There's a couple of federal elections that we'll need to just quickly touch on as well. And there's also some other considerations like earnings and of course month-end flows as well. So let's dive into it, because the main focus point for this week, despite a very full plate for the markets, is definitely going to be on the US data. We've got a couple of very important US economic data points coming up this week. Things like the ISM manufacturing PMI. We also have Q1 GDP, which we'll touch on in a second. And of course, on Friday, we've got the big guns coming up in terms of US non-farm payrolls. Now, let's touch on the GDP print first, because that's going to be, I think, a very key one. When it comes to US GDP, the first thing to keep in mind about this indicator, it is obviously a very lagging indicator, right? We are already almost through the first month of the second quarter of the year, and we're only now getting the first estimate of Q1 GDP. What makes this one more important, though, it is the very first reading of Q1 GDP, and there's a bit of a undecided view among market participants about how bad or how good this data point can actually be. I mean, if we take a look at things like the Atlanta Fed GDP nowcast, we can see that looking at their standard estimate, they are estimating GDP to land somewhere close to negative 2.5%. However, when you account or adjust for imports and exports of gold, you can see that that number gets very close to 0%. So still a massive drop from the Q4 number of 2.4%. But expectations for, at least based on the Atlanta Fed GDP now, is for growth to be settling somewhere close to zero. Now, if you compare that to something like the New York Fed nowcast, they are estimating GDP to be closer towards 2.6%. So there's this bit of a dichotomy between these two, measures. Different measures are showing different things. Is it going to be really bad? Is it going to be a zero print? Is it going to be a plus 2% print? If you take a look at the forecast distribution, basically how wide the market's expectations are for this print, you can see it's ranging from negative 1.5% to plus 1.7%. So that just shows you that the markets really have no clue where this print will come in. Obviously, if we were to see a massively bad print, not just a negative number, but something, let's say, below 2% or close to negative 2%, that should be something that, just ratchets up a little bit of that negative sentiment that we saw in equities from a couple of weeks ago. It should also be a negative driver for the US dollar. However, if we were to see a plus 2% number, right, going towards the upper end of that scale, that could see a little bit of further easing to the upside for equities, relieving some of that, recession fears that we've been seeing building for the markets. And that could also be a possible positive driver for the US dollar as well. So US GDP going to be a very interesting one this week. The other one that has potential to move the markets, but it's going to be a tricky one to trade, will be the ISM manufacturing PMI. Now, if we quickly take a look at what this data looked like last week, and obviously with the prior print, let me just quickly bring that up. And let's start here with the prior month's print. I mean, the prior month's print was a little bit of a gnarly one, right? We had a very classic stagflation print where we saw prices paid, which is basically a leading indicator for inflation. We saw that jolting all the way up to 69.4, which was a negative. And obviously we saw downside for all the growth measures. So employment surprised lower, new orders, which is a forward-looking indicator for future production, that surprised lower, and the headline index was dragged lower as well. So you had growth down, labor down, but inflation pressures up. Stagflation, that was a bad one. So the first question mark for ISM this week is whether we will see a convergence of that, right? Whether we see slightly better growth data coming out, whether we see a stabilization in terms of new orders and employment, whether we see downside for price pressures, or whether we see just another extension of that stagflation fears. That's going to be a key focus point, firstly, for the ISM. Now, what makes this one a little bit tricky is if you take a look at what happened to the flash PMI last week for the US, we saw a downside surprise for services, which is the more important one because it's close to an 80% share of GDP. But we did see an upside surprise a better than expected print coming out for manufacturing. Now, that complicates the ISM print for us this week for two reasons. Firstly, remember that when it comes to things like the flash PMI or even the ISM, these are sentiment-based measures, right? This isn't tracking actual growth or actual employment or actual production. This is tracking sentiment towards those aspects of these businesses within that sector, right? Obviously looking at manufacturing. So there's a chance, according to some, that we might actually see manufacturing, just like with the flash PMI number, with the ISM surprising massively to the upside. Not because everything is suddenly hunky-dory in the economy, but mainly because a lot of businesses might have been front-loading orders, buying in additional product, obviously looking to push through a lot of product ahead of potential tariffs that was expected to come in, announced at the start of April. Remember, the Liberation Day tariffs, as they call it, those initial tariffs was announced at the start of April. So if we were to see a massive upside surprise, the markets could discount a better number because they could say, okay, well, it's only good because businesses front-loaded in terms of the expected tariffs. Now, what if the data comes in really, really bad? The markets might be able to discount a bad number as well, because remember, again, it's a sentiment-based measure, and a lot of the sentiment will be because of the earlier announcements we had about Liberation Day tariffs at the start of the month. But remember, Trump already walked that back. We had the 90-day pause coming into effect, which means that a lot of the sentiment gauges that we get from businesses might not fully account the de-escalation that we had in tariffs as well. So there could be a little bit of a discount going on for both a positive as well as a negative print when it comes to that manufacturing one. So even though, as always, the ISM manufacturing will definitely be a key data point for us to watch, it might not pack the same amount of punch that we used to because of the reasons that I just explained. The big focus, though, as always, is going to come down to the labor market. What does non-farm payroll show us? Remember, we had that surprise to the upside last month coming in at 228 when nobody was expecting it. Market's baseline expectation is for 135,000 jobs added for the month of April. But again, we can see the forecast distribution here is massive, right? A minimum expectation of 50K and a maximum of 170. When it comes to the labor market, this is the most important one for the week ahead from a data point of view, because this is one where we haven't really seen any cracks showing up yet, right? There's a lot of the forward-based measures or leading indicators that has shown us that there's some cracks showing up in the economy, right? That's why the markets have been so fearful of a potential recession coming on. But we are yet to see any of that stress reflected in the labor market, right? We've seen a couple of analysts and participants coming out over the course of the last 2 weeks talking about the similarities between what we're seeing right now in the markets, between the dot-com bubble, between the global financial crisis, how the markets, even the bounce in equities right now has been seen mainly as a bear market bounce as opposed to a recovery. And a lot of these similarities that's been pointed to doesn't really account for the fact that the labor market is still fine. If you take a look at the bear market rallies that we had, for example, in the global financial crisis, those were crazy rallies, just like the one we're seeing right now in equities. But the big difference is that the labor data was already showing massive amounts of cracks when those things occurred, and we are yet to see that happen. So the labor data is going to be a key focus point. If you take a look at the forward or the leading indicators for things like the labor market still looks fine. If you look at unemployment based on the initial jobless claims data hasn't gone up at all. Normally, if there's real stress in the labor market, you would expect initial jobless claims to jolt higher and at least print new cycle highs. We are nowhere close to the cycle highs when it comes to initial jobless claims. So bottom line is, if the data was to show that the labor market is still doing okay, it doesn't have to be a spectacular number. As long as it's just an okay number, close to market expectations, that could be yet another positive driver for things like the US dollar, as well as equities in the week ahead. Obviously, if we were to see a very bad print, anything I would say below 90,000 or close to below 90,000, that could start seeing some additional recession fears picking up, and that could be a negative driver for both the dollar as well as US equities. But if you take a look at things like positioning, let's quickly touch on, let's take a look at the dollar aggregate. We can see how stretched the markets are right now in terms of those those short positions that's been built up for the US dollar. So as a short-term trader, looking at these risk events, my preference would be to trade the dollar on the upside if we were to get really good data, as opposed to trying to press dollar shorts on bad data. You would expect the dollar to weaken on bad data, but equities might be a slightly better way to express that, just because equities have rallied quite a lot. So what do I mean by that? If we take a look at this chart, this is showing us the US dollar. Even though we've bounced, we are barely off the lows, right? So if there's really good data, you would expect there to be a little bit of a catch-up move to the upside for the US dollar. If you compare that to equities like the ES or the US 500, that's put in a very decent rally already. So this, you would prefer to trade lower on very bad data. With the dollar, you would prefer to trade higher on really good data. So that's just a way of looking at trying to squeeze a little bit more out of that, from a price action point of view, based on the different outcome that we get. So US jobs data, GDP, and obviously the ISM, those will be really critical ones for us to watch. Now, we've got a couple of other data points scattered alongside the week for the US as well. We get the PCE, which is the Fed's preferred measure of inflation. We also get things like the JOLTS job openings. Now, those things will feed into the NFP print, so they will be important for us to watch as well. Now, apart from US data, the other big focus for this week is, of course, big tech earnings. We've got a couple of monster names coming up this week, guys. I mean, we've got the likes of Microsoft, we've got Meta, we've got Amazon, we've got Apple. So it's really a big tech week. Now, in terms of importance, the reason why these names are important is not just because it's popular consumer names. Look at the weightings that these names have in the key indexes or indices like the S&P, the NASDAQ, and the Dow. Let's take a look at Microsoft, for example. Close to a 6% weighting in the S&P, over 11% weighting in the NASDAQ, close to an 8% in the Dow. Same story with Apple. 6% in the S&P, 12% in the NASDAQ, 4% in the Dow. Why are these numbers important? These numbers are important, guys, because if we were to see massive upside or downside surprises, not just in the earnings numbers itself, but also in the guidance from these companies, that can really move the markets. It's not just enough. These names carry a big enough weighting that if something massive happens and we see huge downside or upside in any of these names, it can impact the overall indices as well. So you could see the S&P as well as the NASDAQ respond to big surprises coming out from these names. So they will be important. Now, in terms of the numbers, of course, there will be focus on the EPS as well as revenue and how they perform versus these estimates. However, it's all about the guidance, right? Yes, the numbers matter, but what's even more important is how does these companies say the recent tariff news, how has it impacted their business decisions, right? Is it impacting their hiring plans? Are they no longer looking to hire people when they were expected to hire people 2 months ago, right? Has that impacted hiring plans? Has it impacted future investment? How are they seeing the recent tariff announcements? How is it impacting their cost pressures? Those are the key focus points. Any overly positive or overly negative guidance will have an impact in a week like this, especially for these big weighted names. Now, it's not just about big tech though. If you take a look at things like Visa, things like Honeywell, you've also got Caterpillar, you've got McDonald's, Amgen. These names are important for the likes of the Dow. The difference between the Dow and the S&P and the NASDAQ is the S&P and the NASDAQ is a market cap weighted index, right? So the market cap of the company dictates the weighting of the stock name in the index. For the Dow Jones, it's price weighted. So it's all about the price, the stock price, which impacts the weighting. And there you can see these big names will be important for the Dow as well. So earnings, another key focus point that we need to watch. Now, then we also have some elections going on. We've got the federal election currently taking place in Australia. And we also have Monday, we have the Canadian federal election as well. Now, between these two, the Canadian one is by far the more interesting one from a market perspective point of view or market implication point of view. there's really two things that can happen for the Canadian election. The first one is that we get the Liberals with Mark Carney in the lead winning the election. If that's the case, that removes a lot of the uncertainty. Carney is seen as a little bit of a saving grace, if you will, for the Liberal Party, because just a couple of weeks ago, before we had Carney stepping up when it was still Trudeau, things weren't looking good for the Liberal Party, right, from a polling point of view. Now that Carney has come in, he's put up a really, a strong face, if you will, against the likes of tariffs, talking a really strong game. The markets, or at least from a polling point of view, polls has really shown that has increased the popularity of the Liberal Party once again, from a polling point of view at least. So right now, the odds are for Carney taking the lead with a small minority in the government. If that's the case, that could see a little bit of upside for the likes of the Canadian dollar. I mean, if you take a look at the dollar CAD has done, or the CAD itself has done extremely well, despite all of the tariff nonsense going on. We've seen dollar CAD trading back down towards 138 a couple of sessions ago. Now, a lot of this is not Canadian dollar strength, of course. A lot of it is just US dollar weakness. But the bottom line is the CAD has held up pretty well, despite their biggest trading partner, who takes close to 80% of their exports, slapping tariffs on them. The economy has done okay. The Canadian dollar has done okay. If the Liberals should win, it should provide some further upside for the likes of the CAD. If, however, there is a hung parliament, right? So if we don't get even a small minority coming out and we actually get a hung parliament, that's probably the most negative outcome for the Canadian dollar, and that could see a little bit of upside for the likes of the dollar CAD. So Liberal win with a decent margin, expected for some downside risk for dollar CAD. If it's a hung parliament, expecting some upside risk for the likes of dollar CAD. Obviously, their key levels to watch out for: the recent lows coming in at 137.83. If that level folds, look out for those key psychological levels: 137, 136. We don't have a lot stopping all the way back down towards 134. And then to the upside, obviously, first key level of resistance will be that 139 psychological. Above that, we've got the 140. Also very close to that swing low going back to the third. So key levels to watch both to the up as well as to the downside. Now, other data points that we can also look at, we do have quarterly CPI data coming out for Australia. Now, look, I doubt whether this one is going to be a big mover for us this week. If you take a look at where we are currently sitting for quarterly GDP, let's look at the monthly measures first. We can see that both the trimmed mean, which is the RBA's preferred measure of core inflation, as well as the weighted CPI headline month-over-month or year-over-year print, both of those are sitting comfortably in the bank's 2 to 3% target band. Right now, the prior quarterly print for the annual trimmed mean printed at 3.2. Expectations is for this to drift back inside that range. Now, if we get anything like that, anything below 3% for the trimmed mean, basically should just keep rate cut expectations for the RBA intact. Right now, we can see the markets have fully priced in a cut for that upcoming meeting for the bank. They're pricing in 26 basis points worth of easing. If we were to get inflation on the quarterly level, moving to that target band between 2 and 3%, I don't see that changing anything for rate expectations, which means it shouldn't change anything for the Aussie dollar. If we were, however, to see those core measures staying above, for whatever reason, above the target band, above that 3% level, that might start to see the markets trimming back some of those cut expectations. It shouldn't be enough to completely discount the cut or completely reverse the cut expectations, but it could be something just worth noting as a short-term mover to the upside for the Aussie if we were to get an upside surprise for that quarterly data. Some of the other risks that we need to be aware of, apart from that, we've got Chinese PMI data coming up as well. Obviously, the focus there will be to see what type of impact the recent tariff situation has had on China. That could have an implication on key markets like copper, key markets like the Aussie dollar, both very closely correlated, of course, to China. Apart from that, we've got the BOJ policy decision coming up on Thursday as well. Now, as usual, it seems like the Bank of Japan is the only central bank that doesn't work with watches, because we never get a set time for when the decision will take place. Look, right now, the markets are pretty sure that we're not going to get any changes in terms of rates coming out for the BOJ. We can see here, looking at expectations, there's a 92% probability that the bank holds rates steady, which is the baseline expectations for the markets. The biggest focus there then is what they have to say about the guidance. What did they have to say about the recent CPI data that we had? Do they see, do they ramp up the hawkish rhetoric? Do they dial it down? When it comes to the BOJ though, as you guys have seen over the course of the last few meetings, it's just all over the place. Their guidance has been so mixed. They talk a dovish game, then they do something hawkish, or they say something hawkish, then they play a dovish game. I have no interest at all in trying to trade something like the BOJ. It's just been a complete mess of a communication, from a communication point of view. So I've got no interest in that in the week ahead, but that is obviously something worth watching, especially based on the positioning information. If you take a look at what's happened to the yen, we have not seen this stretched long position in the Japanese yen going back all the way to the GFC, right? The markets are very long from a speculator point of view on the Japanese yen right now. What does that mean in the context of the BOJ? Or even risk sentiment this week? If US data was to come in a lot better than expected, based on this positioning, that could see a little bit of further unwind in those long positions, forcing the yen lower or forcing yen pairs higher then, if you will, things like dollar yen. Alternatively, if the BOJ should, for whatever reason, sound a little bit more dovish in the week ahead, that positioning could also pose a little bit of a risk for yen long. So that is just something worth keeping in mind as a possible risk as well. Now, the other thing we can watch or just be aware of in the week ahead is month-end flows. We've got corporate month-end taking place on Monday, and we've got official month-end taking place on Wednesday. What does that mean? Normally, when we have month-end, corporate as well as official, it can impact the way that currencies trade in the short term. Those movements from a month-end flow point of view is very difficult to dictate, right? You've got very, very clever investment bankers out there that's built models trying to track what type of demand there will be for various currencies at the end of the month. Those models consistently get it wrong, right? So it's very difficult to say, oh yes, we're going to have dollar demand, or we're going to have, more supply. It's very difficult to say which one will win. The bottom line is, if you're going to be trading FX Monday, Tuesday, Wednesday, and you see some weird, strange moves happening, especially around the London fix, which is 4 p.m. If you see that happening, it might just be down to month-end flows. It might have nothing to do with your strategy, nothing to do with the fundamentals or the macro. It might just be month-end flows that is impacting those currencies. So be mindful of that as a potential risk for currencies in that first 3 days of the week as well. So that is a pretty jam-packed week, as we said, for the markets, guys. So be very, very cautious when it comes to those US data points. Make sure to mark them up in your calendar because they will be big. They have the impact to really move the markets, obviously depending on the outcome that we get. So with that said, hope everybody will have a fantastic week ahead. And as always, any questions, don't hesitate to let me know.